Are you escrowed? Well, you should be. I speak of Patrick Quayle today about escrow accounts, where your taxes and home insurance are escrowed. The bank has a fund, an escrow account on your behalf for those funds. There are some advantages, some disadvantages. As you'll see from this video, there will be a lot more advantages than disadvantages. In fact, unless you're a Bill Gates genius, I would recommend that you escrow your funds.
Okay, so hopefully through the power of social media, I believe that live broadcast is working. So we're live streaming. Great. This is Patrick Quayle, your host of the Wicked Awesome Report, joined by my co-host Declan O'Toole from Select Real Estate. Good morning.
Morning, Patrick. How are you?
Things are well. Things are well. So we're broadcasting another edition of the Wicked Awesome Report, doing this every Tuesday and Thursday morning at 10 a.m. Give us a comment, a like, thumbs up there. Head over to the Facebook page for Wicked Awesome Report. You'll be notified when we do go live again. So today we're going to talk about escrow accounts, and it seems to be every once in a while seems to be a theme or a pattern. And lately I've been talking to a lot of clients about escrow accounts, and they're confused about a couple of different things when it comes to their escrow account. So, we have a pattern like that. Always seems like a good topic for a show. Try and get some good info out there and clear up any confusion that may be out in the general public. So let's talk about escrow accounts.
So Patrick, just to clarify too, on escrow accounts, we're talking about the escrow account that your mortgage company has when you're paying a mortgage that they have as the extra funds towards taxes and insurance.
Exactly. Right? Yeah. So that's different than, when you're buying a home and a deposit is held in escrow. So what we're talking about is you've already closed on your home, or you're about to close on your home, and you have an escrow account for real estate taxes and homeowners insurance. So what the hell is that? What does that mean? Okay. So when an escrow account is set up, what a consumer is doing is they're paying the cost of real estate taxes and homeowners insurance on a monthly basis. So they're making that payment to the loan servicer. So their payment includes principal and interest, which is the repayment of the dollars that was borrowed. And there's a amount for a real estate tax escrow and for a homeowner's insurance escrow. So you're paying the annual cost of taxes and insurance on a monthly basis. So it's sort of like a forced budget or a payment plan when it comes to taxes and insurance, so that when the insurance binder comes up for renewal, a year from now, you're not surprised, although you shouldn't be surprised, but you're not, surprised by a bill that shows up and, could be a couple of $1,000s for your annual homeowner's insurance. And same thing with real estate taxes. You get that bill once a quarter. You don't have to be surprised by that. And now, again, it shouldn't be an unexpected bill, but when it's escrowed as part of your mortgage payment, you're paying that cost every single month. It's not a lump sum payment a couple of times a year or once a year.
And then just even to get back to just the legality of it, what an escrow account is, I'm just going to read a definition to you.
Sure.
Escrow is defined as a legal arrangement with a neutral third party where money is deposited per the terms of that contract. When it comes to your mortgage, your loan servicer acts as that neutral third party. So the funds aren't, it's not in, the funds are set aside per the escrow to make those payments. And the contract is assumed at the closing table with your certain.
Yeah. So your loan servicer is not putting that money in their pocket. They're putting it aside in a separate account that the funds you pay in are going to be paid out toward your taxes and insurance. So as the homeowner, you're always going to get a tax bill in the mail. So the municipality, the city or town doesn't necessarily know and doesn't really care whether your taxes are escrowed or not. You're the homeowner, they're going to send you the bill. Okay, so I get calls quite often when those tax bills comes out, say, oh my God, I got this bill. What do I do with it? So explain to the clients, yep, that's fine. You're going to get that bill because you are the homeowner, but you're paying your real estate taxes with your monthly payment. The loan servicer is also getting a copy of that bill and they're going to pay the taxes to that, city or town from the amounts you've been paying in every single month into that escrow account.
So
And
Patrick, just a quick question on that. So you're talking about that separate bill from the town. When you get a mortgage, do you always have an escrow account paying your insurance and your taxes?
no, so you don't have to. Well, I take that back. You don't have to, depending on the terms of the loan and what that lender requires. So typically on higher loan to value loans, so if you're giving a smaller down payment, pretty much every lender is going to require that you do have an escrow account for taxes and insurance.
So they don't just
However, with lower loan to value, so you have a stronger equity position, loan servicers will let you waive the escrow accounts, meaning that you don't have to. It's not required. Um, so it really depends on the terms of the transaction as to whether or not you will or won't have escrows. And I would tend to think probably more than 95% of the transactions will have an escrow account. Um, Even if it's a lower loan to value, I think it's sort of a good budgeting tool. So again, even though you shouldn't be surprised, you're not surprised by that quarterly tax bill or that annual homeowners insurance bill when it comes due.
quick question. Like most loans, right, would be FHA or VA. Certainly, would cover a lot of those. If you've got a large down payment, we'd say more than 20%. Do you still escrow with a VA or an FHA loan?
Yeah, so the government entities are pretty much going to require that the escrows be part of the transaction. So on conventional loans, so non-government loans, so not a VA or FHA or USDA, conventional loans, those are where you have the option as to whether or not to waive your escrows.
Gotcha. So Patrick, I think you kind of hit on it. So in terms of, I assume there are pros and cons that come with
Mhm.
having escrow. I think you hit on one of the pros is that it's automatic. You can kind of check the box and the payments are made.
Yep.
Is that always so? When you set up in terms of the process, are there any other shortfalls other than the fact that that's automatically everything's automatically paid? Is there,
Yeah, well, you still want to keep an eye on your escrow account with the lender and just make sure that that real estate tax payment is being made, the insurance payment is being made, and there's a couple of different ways to go about that. So every single year, the loan servicer is required to provide you with a document called an annual escrow analysis. Okay. And that's a document they're going to send to you. Typically happens on or about the anniversary date of your loan. So if you're closing your loan in August, every August you should be getting an annual escrow statement, annual escrow analysis. And what that document is going to do, it's going to show you every single payment you made with money going into the escrow account. So all the dollars you paid in, and it's also going to show all the dollars that came out. So what tax bills were paid and how much, what insurance bill was paid. So again, it's sort of like, you know, like a bank statement, I guess, all the funds paid in and all the funds paid out. So that's one way that you can just make sure that it's being paid appropriately, but you don't have to wait. You don't have to wait for an annual escrow analysis to come out. You can call your loan servicer and request an earlier escrow analysis and get a printout of all the money you've paid in and all the money that was paid out, just to make sure that it is being handled appropriately. Now, most loan servicers on your monthly bill are going to show you that breakdown when a tax or insurance payment has been made. It's going to show up in sort of the details of transaction on your monthly bill.
So another question I suppose I have for you is, with the bank, how do they know that they're going to be covering? So this is amount that's put in escrow until there's a bill essentially, and they pay it each time. So did you ever get a situation where you go over on the amount you pay, or actually more to the point that it's not being paid, that it hasn't been covered?
Yeah. So, it's again, it's the budget, and sometimes budgets change. Okay. So at the time of closing, the escrow amount that's being collected is based on what those taxes and what that insurance currently is. Over time, unfortunately, costs for taxes, insurance rarely go down. Okay. They typically go up. So one of the things that happens when there's that annual escrow analysis that's done, usually it ends up with either an escrow overage, where for whatever reason they had been collecting too much money, and you get a check back because the loan servicer is only allowed to hold on to a certain amount of money in those escrow accounts. So if they exceed that balance, you get a check back.
So
That
at the end
that
of the year,
happens, but it's fairly rare. Yeah. So once a year, that annual escrow analysis.
okay.
What's more common though is when the taxes or the insurance goes up, and now there's what's called an escrow shortage. So you haven't been paying enough in to cover that tax and insurance bill. Now the loan servicer is still going to pay the taxes, still going to pay that insurance bill, but now you have a shortage. So think of it like your checkbook, and you ran into a negative balance. Okay, you wrote too much out, and checks were cashed, and now you've got an insufficient balance. But you don't get hit with a bounce check fee or anything like that. The loan servicer is going to pay that bill, but whatever that shortage is, you have to make that up. And there's a couple of different ways you can make it up. So number one, if there is an escrow shortage because taxes or insurance went up, just right off the bat, your payment is going to change. Okay, so your payment going forward has to increase in order to cover what that higher cost of taxes and insurance in the future is going to be. That only makes sense. If taxes go up, you have to pay more to cover those higher taxes. But there's also that shortage that exists right now. So, a tax bill worked out to be, let's say, $600 more than what was anticipated. The loan servicer paid that, $600 extra, and now your escrow account is $600 in the negative. That's the shortage. So the lender is going to give you, loan servicer is going to give you a couple of different options typically. So number one is going to be a lump sum. Okay, so there's a negative $600 balance. Write us a check for $600 to bring it current. All right, that makes sense. If you don't have the financial capacity just to, cut a check for $600 as out of the blue, loan servicer will typically give you the option to pay it over time. Let's say, again, simple math here, it's $600 shortage. You can make it up over the course of 6 months by an extra $100 a month going on top of your regular payment. So again, even if the tax bill comes in and the insurance bill comes in higher than what had been collected, you're not going to go with insurance premium not being paid. You're not going to go with your real estate taxes not being paid. Loan servicer is going to cover that, but they're going to circle back and look to recoup the extra amounts they paid out on your behalf.
So I suppose it sounds to me like from the bank's perspective, they obviously, it's to their advantage to have an escrow in most situations.
Absolutely. So think about it like this. So the home, the real estate, that's the collateral for the dollars being borrowed. Okay, that's the collateral for the several hundreds of thousands of dollars that they put out there.
Mm-hmm.
The loan servicer wants to make sure that that collateral is properly insured. They want to make sure that insurance policy remains in place. They want to make sure that there isn't a lapse in insurance because Murphy's law, insurance lapse, and that's the day the house burns down. Okay, right. And there goes the collateral for the several $100,000 loan amount. So the loan servicer wants to make sure there's always adequate homeowners insurance, and with real estate taxes. So don't want to play lawyer without a license here, okay? But what can happen is if real estate taxes go unpaid, the municipality can place a lien on the property, okay? And that becomes what's called a super lien. So it supersedes the mortgage. So the municipality actually could have the ability to foreclose based on non-payment of taxes and potentially wipe out the mortgage balance as part of that. So as a loan servicer, you want to make sure the town doesn't step in and wipe you out. So that's part of the reason why a loan servicer wants to have tax escrow as part of the transaction, so that they can make sure that their interest in the property is protected against any potential tax liens that may come up, real estate tax liens.
So based on that, Patrick, so obviously the VA and VHA, FHA, uh, we've considered that they will, it's automatic that you have an escrow, but
It's mandated with those. Yep.
it's mandated with them. So if you've got a, let's see if you've got another situation, I mean, are there any incentives for a buyer, would say, that may have an option to escrow or not escrow, given that it's to the advantage of the lender to have
Yeah,
it?
I mean, so there is an upfront cost as well. So when you're purchasing a home, and it doesn't matter whether you're escrowing or not, but you have to prepay a certain amount of both taxes and insurance. So you're paying a certain amount in advance. But over time, if you want to manage your money, maybe there's a short-term gain that can be had. So rather than sending a couple of $100 a month into the escrow account, you're investing it someplace else and making a couple of bucks on your investment, and then pay your own taxes and your insurance. Now, that's really not for everybody. I've certainly seen transaction with clients that were adamant that they didn't want a tax and insurance escrow. And after the fact, they were not all that happy with that decision they made, because now this real estate tax bill comes once a quarter. They're not always prepared for it. That insurance bill comes due once a year. They're not always prepared for it, even though it shouldn't be a surprise that, they know they have taxes and insurance to pay. So, when I look at the two sides of the coin, I tend to think that there's more advantages to having an escrow account and having that sort of forced savings or forced budget, so that you're not hit with a surprise every quarter or once a year. Really, only surprise is going to be if and when taxes and insurance do go up. It's a slight increase in what those payments are.
So let's say you're somebody, just to be devil's advocate, that would prefer to put the money into a CD, maybe a money market account or a savings account. And again, it doesn't sound like a lot, but you have that extra savings maybe with the time value of money.
Yep.
Is there any way let's say you start out with an escrow, is there any way to get rid of an escrow or to scale back on it? Or?
Yeah. So you can, so it's not necessarily an all or nothing, and there is one kind of exemption to that. So if the property is in a flood zone, in addition to homeowners insurance, flood insurance is required. And when there's flood insurance involved, it is an all or nothing proposition. Okay. So when there's flood insurance involved, you can't just escrow for flood insurance and not for homeowners or not for taxes. It's going to be all or nothing. Okay. But again, let's put that aside. That's just a specific example just for flood insurance. So for most transactions, you can escrow just for taxes or just for insurance, for both or for none. Again, it depends on what the lender's required loan to value is to waive escrows. So I have some clients that will escrow for real estate taxes, because that's typically a larger expense and it comes out once a quarter, and they'll pay their own homeowners insurance. Maybe they've got some sort of employee benefits package where all the employees of a company get a discounted homeowners insurance rate, but it is paid out through their payroll deduction or something like that, as opposed to having an escrow. I've certainly seen that. That's one example where you would escrow for taxes, but not for insurance. So it's not always an all or nothing package. Gotcha.
So if you're looking at it, it sounds to me like, kind of going into this, pros and cons. The pros are it's automatic. Just from what the answers you give me, it's automatic, covers the shortfalls, no surprises, except for at the end of the year, you may have to do an escrow payment. And there's not always an incentive, but are there ever mortgage incentives in terms of the interest rate on a fee?
Yeah. So again, depending on the loan product, from a lender's perspective, when you don't have escrow accounts, it's a slightly riskier transaction, because again, if the insurance lapses or you don't pay your taxes and now there's a tax lien, it impacts that lender's position in the property and the value of the collateral. So from a lender's perspective, if you're going to waive your tax and insurance escrows, they're looking at it as a slightly riskier transaction, and they may actually charge you more, either an interest rate or an upfront cost, to say, okay, we'll let you manage your own escrow accounts, but for us as the lender, that's a little bit of a riskier proposition. There's a risk premium involved with that. It's going to cost an extra X amount of dollars in terms of interest rate or X amount of dollars in terms of upfront cost to allow you to manage your own escrow account. As ridiculous as that sounds, that's the truth.
So the default, as far as the lender is concerned, you're going into this, you're getting an escrow, and that's why it's more of a disincentive not to go with the escrow than it is an incentive to actually go with it in the first place.
Yeah.
Interesting. So, all right, that sounds good. So, I mean, if you look at it, like there, the pros, the cons are, again, I see it as small as well, but you never know, depending on what your situation is. Cons would be that, you miss out on an investment opportunity, I suppose, to your savings. The upfront costs, obviously, that's something to be taken into consideration. And again, getting rid of it is not so easy if your situation changes or your mind changes. But
well, exactly, yeah. I mean, as you paid on that loan balance and now you're at a lower loan to value, it is possible to request that the escrows be removed. But again, it's a request. The lender's really not under any obligation to grant that request.
Got it. Well, sounds good. I think we've covered it. I think from
my
perspective,
So again, the some of the important things to remember is, as a homeowner, you're always going to get that tax bill in the mail. You're always going to get that insurance bill in the mail because you're the homeowner. Okay, so the city or town doesn't discriminate against whether you have escrows or not. They don't necessarily know. They don't care. They're going to mail the bill out to every homeowner. Same thing with homeowners insurance. You're going to get that renewal binder. You're going to get that bill, that statement that shows you insurance is coming up for renewal. And as a homeowner, the best thing that you can do is call your loan servicer, get an escrow analysis statement, look at your bills, and make sure that the taxes and the insurance are being paid out appropriately. So every single mortgage bill is going to have an 800 number for you to call for the escrow department. Okay, so you can call them and just make sure that that tax bill was paid, that insurance bill was paid. Again, the loan servicer is managing that for you, but as a homeowner, you don't want to just completely just abdicate responsibility. Sort of trust but verify. Okay, they're collecting the payment. You just want to make sure that those are being paid out in the appropriate fashion.
Patrick, have you come across situations where the lender has missed a payment or they've fallen behind?
Yeah, it does happen. It does happen, and in the event that does happen, specifically for real estate taxes, if the town assesses late charges, interest on that late payment, the homeowner is not responsible for paying that overdue interest or penalties. The loan servicer is responsible for doing that because it's their screw up. They made the mistake of not sending the payment on time.
Another reason to have the loan servicer make those payments.
Well, exactly. Yeah. So again, looking at the pros and cons, I certainly think there are more pros to having the escrow accounts than there are to trying to manage it on your own.
Very good.
All right, so escrow accounts in a nutshell. I think that gives a lot of good, just basic info. So again, it's you're gonna get that bill in the mail. Don't panic. Check with your loan servicer and make sure that those payments are going out appropriately. And always take a detailed look at your annual escrow analysis statement that you'll get. Again, usually about the on or about the anniversary date of when you took out that loan. Those are the best pieces of advice I can give you to manage your escrow account going forward. So Declan, why don't we call it a wrap? That's a
good to me.
Quick review of escrow account statements. I'm Patrick Whaley, your friend in the mortgage business, host here of the Wicked Awesome Report, joined by my co-host, Declan O'Toole from Select Real Estate. Thanks for hopping on this morning, Declan.
Thanks for having me, Patrick, as always.
So Wicked Awesome Report, broadcasting every Tuesday and Thursday at 10 a.m. Head over to the Facebook page for Wicked Awesome Report. Give us a thumbs up, a like, a comment there, and be notified when we have our next live broadcast. So until next time, I hope everybody out there stays well and stays awesome. Take care.
See everybody Thursday.
All right, let's end the live stream.